Okay, so usually when we talk about a major geopolitical crisis, there's this expectation of physical containment.
Right, like a fire you can put out.
Exactly, like you see the footage on the news, you know exactly what region is burning, and you can point to a map and say, that is where the problem is.
But that's just not how things work anymore, is it?
No, not at all. I mean, step into the modern reality of globalized finance, energy supply chains, and digital infrastructure, and suddenly that fire isn't contained at all.
It spreads instantly.
Right. We are looking at a landscape where the sparks from a kinetic conflict on one side of the planet instantly ignite, like this financial chain reaction that actually alters the digital wallet in your pocket.
It's incredible how fast it moves.
It really is. So today, for this deep dive, we are connecting the dots between a barrage of drone strikes in the Middle East, a massive boardroom brawl in Silicon Valley, and the exact interest rate you are paying on your mortgage.
Yeah, we've got quite the lineup today.
We really do. We have a fascinating stack of sources to unpack, and our mission for you today is to basically make sense of a truly chaotic mid-July 2026.
It is the absolute definition of a highly sensitive, deeply fragile global system. I mean, on the surface, the geopolitical updates, the central bank maneuvers, the quiet moves by traditional Wall Street, and these disruptive tech acquisitions, they read like 4 different news channels playing on separate screens.
Yeah, completely unrelated at first glance.
Exactly. But as we dig into the mechanics of these events today, you realize they are all tied together by one invisible, highly conductive thread.
The global flow of capital.
Precisely, and we are going to track that flow today.
Okay, let's unpack this. Let's start right at the geographic center of the physical chaos. We are looking at a severe escalation in the U.S.-Iran conflict, and this is specifically centered around the Strait of Hormuz.
Which is always a flashpoint.
Always. Based on the live updates from CBS News spanning July 15th and 16th, the tactical situation has just blown past mere posturing. The U.S. has just launched its 6th consecutive night of military strikes across Iran.
6 nights. That's a sustained campaign.
It really is. And looking at the target list, this isn't just a surgical operation aimed at a few radar dishes.
Far from it. The scope of the targeting really indicates a systematic degradation campaign. I mean, when you look at the reports from U.S. Central Command or CNTCOM, we are talking about multi-hour waves of attacks.
Wow, so not just quick in-and-out strikes.
Right. They are hitting coastal defense systems, missile launch sites, and drone command centers. But the geographic spread is what really stands out here. The strikes stretch from the major port city of Bandar Abbas to Hormuz, Bushehr, and all the way to Kesh Island.
Yeah, and the Kish Island strike is a perfect example of how broad this has gotten. The sources note a fish meal factory was damaged there.
The fish meal factory.
Right. And at first glance, hitting a fish meal factory seems like almost random.
It sounds like a mistake.
It does. But in a total blockade scenario, degrading any industrial or logistical infrastructure, especially anything that might have, dual-use warehousing or supply chain utility, that becomes part of the objective. It's basically an economic strangulation tactic.
That is the grim reality of this kind of campaign. The ultimate goal is to eliminate Iran's physical capability to threaten commercial shipping in the Strait. But achieving that requires reaching deep into Iranian territory.
Which means civilian areas get caught in the crossfire.
Absolutely. For instance, Iranian state television confirmed a strike on a barracks for the 388th Mechanized Infantry Brigade in the Sistan and Baluchistan province.
And that specific hit involved at least 13 missiles, leaving 7 dead, including conscripts. And the fallout is bleeding heavily into the civilian sphere, like we just said. The situation in Avaz right now is incredibly tense.
The hospital situation.
Yes, exactly. According to the Iranian Health Ministry, strikes hit locations immediately adjacent to the Shahid Baghai Hospital, and this facility actually specializes in pediatric cancer and blood disorders.
That is horrific.
It is. Because of the sheer proximity of the blasts, the hospital director, Dr. Majid Bouazar, had to completely evacuate 211 hospitalized patients.
Which instantly transforms a tactical military action into a massive diplomatic pressure point.
Oh, absolutely.
Iran's ambassador to the UN in Geneva immediately leveraged this. They sent a formal letter to the UN High Commissioner for Human Rights. They cited the hospital evacuation and the severe suffering and anxiety caused to these children.
It just demonstrates how kinetic warfare inherently generates these humanitarian crises,
Right.
which are then immediately weaponized in the geopolitical information war.
Right, it becomes a talking point instantly. And Iran is actively returning fire. They aren't just absorbing these waves of strikes and issuing UN complaints.
No, they're hitting back hard.
The Islamic Revolutionary Guard Corps and the Iranian military are launching major retaliatory waves targeting U.S. allies and military facilities across the region.
And the geography of their retaliation is just as wide as the U.S. strikes, right?
Exactly. They are launching drones and missiles at U.S. bases in Jordan, Kuwait, and Bahrain.
Wow, so spreading it all across the Gulf.
Yeah, in Jordan, they are specifically claiming strikes on communication systems and fuel storage. In Kuwait, over at the Ali Al Salem Air Base, the targets include radar installations and Patriot air defense batteries.
We even have reports of air raid sirens going off in Bahrain, with their interior ministry actually urging citizens to take shelter.
That shows the scale of the panic.
For sure. Now, countries like Kuwait are reporting that their air defenses are actively intercepting these hostile drones. But the sheer volume, Kuwait detecting dozens of drones and cruise missiles, it shows we are in a highly volatile two-way kinetic exchange.
It's a very hot war right now.
It is. So let's pull back and look at the actual geography of this conflict. Because the Strait of Hormuz isn't just a stretch of water. I actually look at it like a massive, unbypassable toll booth on a single-lane highway.
That's a great way to picture it.
Right. Roughly a third of the world's seaborne energy traffic is forced to pass through this tiny, narrow gap. It makes it incredibly easy for any actor to cause a miles-long pileup with just one stalled car.
The toll booth analogy is highly accurate mechanically. It is a fundamental geographic vulnerability in the global economy.
And everyone knows it.
They do. To understand why this massive pileup is happening right now in mid-July, we really have to look at the mechanics of the June 17th Memorandum of Understanding.
Okay, the MOU that initiated that brief ceasefire between President Trump and the Iranian leadership.
Yes, exactly. The stated goal of that MOU was to manage traffic and de-escalate the whole situation. But the CBS News sources reveal exactly how Iran actually utilized that window.
Which wasn't to de-escalate.
Not at all. According to the spokesman for Iran's Union of Oil, Gas, and Petrochemical Products Exporters, during that incredibly short ceasefire, Iran managed to export roughly 80 million barrels of crude oil.
Wait, 80 million barrels in less than 3 weeks?
Yes.
That is a logistical masterclass in fleshing a system.
It is a staggering volume, and the mechanics of why they do it are crucial to understand here. See, when a naval blockade is in effect, oil production doesn't just, stop instantly.
Right, the pumps are still running.
Exactly. The oil gets pumped into massive domestic storage facilities. But once those facilities hit absolute capacity, you have to cap the wells.
Which is bad, I assume.
Very bad. Capping wells can cause long-term geological damage to the reservoirs. It's an engineering nightmare. So by flushing 80 million barrels out onto the global market during the ceasefire, Iran completely cleared their domestic storage.
Oh, wow. So they basically bought themselves time.
Exactly. That allowed them to keep their wells pumping, protecting their infrastructure, while simultaneously generating a massive, immediate injection of capital.
Which completely undermined the leverage the U.S. thought it had. The U.S. accused Iran of using that time to basically rearm and of continuing to harass commercial vessels anyway.
Which is why the ceasefire collapsed so quickly.
Right. So Trump declared the ceasefire dead and immediately reinstated the naval blockade. But a blockade isn't just like a political declaration. It is a physical enforcement mechanism.
Yeah.
And the incident with the MT Belma illustrates exactly how aggressive that enforcement has become.
Right, the MT Belma. That's a Curacao-flagged oil tanker. CNTCom reported it was transiting international waters, heading directly toward Kharg Island.
And Kharg Island is the terminal for the vast majority of Iran's oil exports, right? Like, it is the absolute heart of their export economy.
Precisely. Now, the U.S. military stated the vessel ignored multiple warnings to alter course.
And you really don't want to ignore a U.S. military warning in a war zone.
No, you don't. When a massive commercial tanker ignores a military warning in a blockade zone, the enforcement options are pretty limited, but they are highly destructive.
Yeah, they didn't attempt a boarding or anything. A U.S. aircraft fired a Hellfire missile directly into the Belma's smokestack.
Which is a very specific target.
I want to highlight the mechanics of that specific choice. A Hellfire is essentially an anti-armor missile. Hitting the smokestack is a heavily calculated move to cripple the vessel's propulsion system, disabling it completely, without actually breaching the hull and causing a catastrophic environmental disaster in the Gulf.
Right, they didn't want an oil spill.
Exactly. It is a highly engineered act of violence designed to send an unmistakable message to every single shipping conglomerate on Earth.
And let me tell you, the commercial maritime sector received that message loud and clear. The data from Kepler, the maritime intelligence firm, maps out the total collapse of confidence among global shippers right now.
The numbers are terrifying, honestly. On a given Tuesday in mid-July, Kepler tracked only 21 transits through the entire strait.
Just 21? That's a ghost town for that waterway.
It really is. But what's even more telling is the routing. The U.S. administration had been heavily promoting this southern route, basically hugging the coast of Oman, insisting it was protected by the U.S. Navy.
And did anyone take it?
Kepler reported 0 transits on that Omani route. Absolutely 0.
Wow. The risk modeling for these shipping companies simply cannot tolerate the reality on the ground. Iran has explicitly threatened to fire on vessels approaching the passage, and, they are executing on those threats.
They aren't bluffing.
No. Kepler verified 56 confirmed incidents in the region recently, and most devastatingly, they report 17 seafarer fatalities.
17 commercial sailors killed, just doing their jobs.
Yes. 2 of those recent fatalities were Indian nationals working on the MT Al-Bahaya and MT Mombasa. And the downstream effect of those specific deaths is massive for global logistics.
Because of the Indian government's response, right?
Exactly. The Directorate General of Shipping in India issued an absolute advisory mandating that ship owners and recruitment agencies immediately cease deploying Indian seafarers on any vessel transiting the Strait of Hormuz.
Which sounds like a standard safety protocol, just keeping people safe, until you realize the scale of India's footprint in maritime labor.
It's massive.
They supply over 300,000 sailors to the global commercial fleet. They are the 3rd largest supplier of seafarers in the entire world. Pulling them out of the Hormuz route effectively paralyzes a massive segment of the maritime workforce.
You literally have ships that simply cannot be crewed if they plan to enter the Gulf.
And the paralysis extends upward into the airspace as well. The European Union Aviation Safety Agency, or EASA, issued a severe directive warning all European carriers to completely avoid the airspace over Bahrain, Kuwait, Qatar, the UAE, and parts of the Gulf of Oman.
Which is a huge chunk of global airspace to suddenly avoid.
It's unprecedented. But the risk isn't necessarily that commercial airliners are being directly targeted. EASA specifically cited the heightened readiness and activation of national and U.S. air defense systems.
So it's the risk of accidents.
Exactly. They are warning about the mechanics of crossfire, the extreme risk of civil aircraft being misidentified by an automated Patriot battery or, hit by the collateral fragmentation of intercepted drones.
The combined effect is the creation of a massive, multidimensional no-go zone by sea and by air sitting directly on top of the most critical energy node on the planet.
So the physical toll booth is shut down, the sky above it is completely closed, and the rhetoric from the leadership on both sides suggests they are entirely comfortable with this reality.
Yeah, if we examine the political posturing impartially, we were watching a masterclass in brinkmanship. President Trump, during a defense industry roundtable in Pennsylvania, laid out a timeline for absolute escalation.
He wasn't subtle about it.
Not at all. He explicitly threatened that if Iran does not return to the negotiating table, the U.S. military will begin systematically dismantling Iranian civilian infrastructure next week, specifically naming power plants and bridges.
The exact quote was, "You better make a deal, you're not going to have anything left."
Yeah.
But he also coupled it with this really odd psychological assessment, claiming Iran wants to settle so badly.
It is the classic dual-track strategy. You present the diplomatic off-ramp while simultaneously revving the engine of total infrastructural destruction, and the Iranian leadership is actively mirroring this posture. The spokesman for Iran's military headquarters issued a direct counter-threat, stating that any attack on Iranian infrastructure would trigger an immediate response targeting all infrastructure in the region.
And which is a thinly veiled threat against the energy facilities, desalination plants, and commercial hubs of U.S. allies like Saudi Arabia and the UAE.
Exactly. Meanwhile, Mohammad Ghalibaf, the Speaker of the Iranian parliament, publicly declared that the armed forces have complete freedom of action, rejecting any obligation to that dead MOU.
This public mirroring of absolute aggression, it really raises the critical question of what is actually happening within the internal command structures of both nations.
Yeah.
And our sources provide a remarkably candid look into this via Vice President J.D. Vance's appearance on the Joe Rogan podcast.
That interview was absolutely fascinating because Vance openly detailed the internal fractures. He didn't paint a picture of a unified American diplomatic front nor a unified Iranian one.
No, he was surprisingly blunt.
He was. Vance specifically targeted a faction within the U.S. political sphere he categorized as hawks. He accused them of actively attempting to sabotage the negotiations, arguing they were feeding misinformation about the MOU granting unwarranted sanctions relief to Iran, purely to tank the deal.
But his breakdown of the Iranian internal power struggle was the real insight there. He outlined a massive split between the hardliners and the pragmatists inside Iran.
Right. According to Vance's intelligence assessment, the hardliners in Iran are in a state of absolute panic over the reinstated oil blockade.
Because it cuts off their money.
Exactly. They view the loss of revenue as an existential threat to their leverage and are the faction pushing for the total militarization and closure of the strait.
Okay, so that's the hardliners. What about the pragmatists?
The pragmatists, however, recognize that the escalation cycle is a strategic trap, and they are actively seeking back channels to resume talks.
Wow. So Vance basically admitted the U.S. strategy is to simultaneously conduct back-channel diplomacy with the pragmatists, while kinetic strikes are used to punish the actions of the hardliners.
Which is incredibly complex to manage.
It creates a chaotic, non-linear conflict where you have competing factions within the same government basically fighting proxy wars over their own foreign policy.
And that internal friction is why we see these jarring, sudden diplomatic anomalies right in the middle of the bombing campaign.
Exactly, like the sudden release of Dina Karari. We have this U.S.-Iran dual citizen who had been trapped under an exit ban since late 2024 on espionage charges.
Right, and she recently suffered a heart attack.
Yeah. And right in the middle of a massive U.S. bombing campaign, she is suddenly allowed to fly out of Iran, with Trump posting about it as a gesture of goodwill.
It highlights the extreme compartmentalization of the conflict. I mean, one faction of the Iranian state is authorizing missile strikes on U.S. bases in Jordan, while another completely separate faction is processing the humanitarian release of a high-value dual citizen.
It's a dizzying geopolitical reality. But let's look at the immediate downstream effect of all this kinetic chaos. Because the reason this deeply complex factional war in the Persian Gulf instantly impacts every single listener is the fundamental mechanism of global energy pricing.
Yes. The physical paralysis of the Strait of Hormuz directly translates to panic in the global energy markets. The CBS sources highlight that the international benchmark, Brent crude oil, spiked to over $85 a barrel, hitting a one-month high.
And oil at $85 a barrel isn't just a number on a terminal. It fundamentally alters the cost structure of the global economy.
It makes everything more expensive.
Exactly. When energy costs spike, the cost to extract raw materials, manufacture goods, and transport them across the supply chain instantly rises. Those costs are passed directly to the consumer. That is the literal definition of supply shock inflation.
Which brings us perfectly to the next critical source in our stack. Because inflation is the exact enemy that global central banks have spent the last 3 years trying to eradicate.
They've been fighting it tooth and nail.
They have. And when a geopolitical shock threatens to reignite inflation, central banks are forced to deploy their only real defensive weapon, monetary policy.
Okay, let's unpack this and move from the kinetic warfare of the Middle East to the highly insulated boardroom of the Bank of Canada. According to the RBC update on July 15, 2026, while the oil markets are reacting to the Hormuz blockade, the Bank of Canada announced its highly anticipated interest rate decision, and they held the line. The policy rate remains locked at 2.25%.
The historical context provided by the source is really vital here. This hold isn't a new posture.
No, they've been parked here for a while.
Right. The BBC has parked the rate at exactly 2.25% since December 2025. Before that, it sat at 2.75% in July 2025. So we are looking at a sustained multi-year strategy of refusing to significantly lower the cost of capital.
And the mechanism here is the overnight rate. When the BBC holds that rate steady, they are actively choosing to keep borrowing costs elevated across the entire Canadian economy.
Exactly. They are deliberately suppressing domestic spending power to offset the inflationary pressure coming from things like $85.
But I want to push back on how this is usually reported, because the headline is always like, rates held steady, no change. But for a consumer, a hold is an active, often really painful event. It is not a neutral pause.
You are absolutely right. The phrasing held steady masks the mechanical reality of how these rates filter down into personal finance, particularly the housing market.
It's brutal for homeowners.
It really is. The RBC analysis provides a brilliant breakdown of this by contrasting the mechanics of variable and fixed rate mortgages in a hold environment. Let's examine variable mortgages first.
Okay, so variable mortgages are tied directly to the prime rate of the major commercial banks, right?
Right.
Which moves in absolute lockstep with the BOC's overnight rate. So if the BOC finally cut rates, the prime rate drops.
Correct. But the mechanical detail that catches so many homeowners off guard is how fixed payment variable mortgages actually function.
Wait, explain that, because fixed payment variable sounds like an oxymoron.
It does, but it's a critical distinction. With many variable products, particularly at institutions like RBC, your actual monthly payment amount does not fluctuate when the prime rate moves.
So I'm paying, say, $2,000 a month no matter what.
Exactly. The payment is fixed. What fluctuates wildly behind the scenes is the internal allocation of that payment between interest and principal.
Oh, I see. So if the BSE had cut rates to 2.2%, my monthly payment stays exactly the same, but the bank takes a smaller cut in interest, meaning more of my money goes toward actually paying down the principal of the house.
Yeah.
I build equity faster.
Yes.
But because the BSE held at 2.25%, that equity acceleration is denied. I'm still trapped paying the elevated interest allocation.
Precisely. The hold forces you to continue treading water. And the risk factor here is what happens if the situation in Hormuz deteriorates further, driving oil to $100 or $110 a barrel.
Right, which would cause massive inflation.
Exactly. And that resulting inflation spike could force the BOC to abandon the hold and actively raise rates. In a fixed payment variable scenario, a rate hike means the interest allocation swallows almost the entire payment.
Wow.
You reach a point where literally $0 are going toward the principal. You are just renting the debt from the bank.
That is the variable trap right there. But what about fixed rate mortgages? If you are a homeowner who locked in a 5-year fixed rate, you might look at the BSE holding at 2.25% and think, this doesn't affect me. My rate is guaranteed.
And that is a fundamental misunderstanding of how fixed rates are actually priced.
Really?
Yeah. The BSE's overnight rate does not directly control fixed mortgage rates. Fixed rates are dictated by the bond market, specifically government bond yields.
Oh, okay. So this is where the geopolitical shock connects directly to the housing market. Bond yields represent the return investors demand for lending money to the government over a set period, like 5 years.
And the bond market is incredibly forward-looking. When bond investors look at the drone strikes in Hormuz, they see supply chain disruption and future inflation.
So they want more money to compensate for that risk.
Exactly. To protect the purchasing power of their money over the next 5 years, they demand a higher yield on those bonds today.
So even though the Bank of Canada did absolutely nothing, even though they officially held the overnight rate, the bond market is already pricing in the geopolitical risk.
Yes, instantly.
Bond yields spike. And because commercial banks base their fixed mortgage products on those yields, fixed mortgage rates rise completely independently of the central bank.
This creates a chaotic environment for anyone trying to navigate the housing market right now. If you are renewing a mortgage today, you are caught in the crossfire of domestic central bank policy trying to suppress spending and a global bond market reacting to kinetic warfare.
Like, you can't win.
It really creates massive volatility in housing affordability and essentially freezes the market as buyers and sellers cannot agree on the true forward-looking cost of capital.
So the actionable takeaway here from the RBC analysts is really centered on stress testing. They are advising clients to immediately run their household budgets against hypothetical rate scenarios that are like 100 to 200 basis points higher than the current reality. Do not assume the 2.25% hold is permanent.
It's good advice. They also emphasize timeline awareness. The central bank operates on a strict schedule.
Right.
The next BTOC rate announcement is set for September 2, 2026. If you are holding variable debt or approaching a fixed renewal, that date dictates your financial strategy for the next 5 years.
Put a circle on the calendar. So we have Main Street stress testing their budgets against the threat of inflation and central banks holding the line to defend the economy. But while everyday citizens are deeply exposed to these macro shocks, there is one sector of the economy that seems entirely insulated.
There always is.
Always. While the world is watching the Strait of Hormuz burn, Wall Street's old guard is quietly projecting an aura of immense, almost boring stability.
The contrast is truly stark. It highlights the deeply entrenched structural advantages of traditional financial institutions during periods of extreme global volatility.
Let's look at the data from Dividend Investor regarding Morgan Stanley. On July 15, 2026, which is the exact same day missiles are hitting hospitals in Ahvaz and the BOEC is holding rates, Morgan Stanley steps up to the microphone and simply declares a quarterly dividend of $1,150 per share.
And that figure is not a defensive posture.
No.
It represents a 15-cent increase over their previous payout. In an environment where industrial companies are panicking about supply chains and energy costs, a major investment bank is actively increasing the velocity of capital return to its shareholders.
The metrics behind this move are staggering, honestly. Morgan Stanley commands a market capitalization of $359 billion. They were trading at a price-to-earnings ratio of 20.62. And this new dividend bump marks their 12th consecutive year of dividend increases, pushing their yield to roughly 2.02%.
They're just a machine.
But I want to get into the mechanics of why they are immune to this macro chaos. How can a bank be this profitable when the global economy feels so fragile?
It comes down to their specific structural evolution over the past decade. Following the 2008 financial crisis, Morgan Stanley made a massive strategic pivot away from high-risk, balance sheet-heavy trading and heavily toward wealth management and investment management.
Wait, they aren't just taking massive directional bets on the stock market anymore. They are managing the wealth of the ultra-high net worth class, sovereign wealth funds, and massive corporate treasuries.
And the beauty of the wealth management model is that it generates recurring fee-based revenue regardless of whether the broader market is going up or down.
It's just steady income.
Exactly. In fact, in a high interest rate environment like the one the BSE and the Federal Reserve have engineered, Morgan Stanley actually benefits.
Wait, really? How?
They earn massive net interest income on the uninvested cash sitting in their clients' accounts. Oh, wow. So while high rates are crushing the variable mortgage holder in Canada, those same high rates are basically padding the margins of Morgan Stanley's wealth management division. It is a perfect structural hedge.
It really is. Furthermore, their institutional securities division, which is the traditional investment banking arm, they thrive on volatility.
Because chaos creates opportunity.
Exactly. When geopolitical shocks occur, corporations need to restructure debt, hedge against currency fluctuations, or execute emergency mergers and acquisitions. Morgan Stanley charges massive advisory fees to facilitate those complex maneuvers.
It is the ultimate toll booth on global capital. The 12-year streak of dividend increases is a very deliberate signal to the market. They're looking at the closed shipping lanes and the tight monetary policy, and they're basically broadcasting, we have the capital, we have the infrastructure, and we operate above the physical friction of the global supply chain.
It is an absolute flex of institutional permanence. They are projecting the image of the immovable object in global finance. But the irony is, while traditional finance projects this calm, immovable stability, the future of finance is currently engaged in one of the most violent high-stakes boardroom brawls in Silicon Valley history.
It's getting messy over there.
We are moving from the quiet confidence of a Wall Street dividend to a $53 billion hostile takeover attempt that could completely restructure the architecture of digital payments.
This is where the structural tectonic plates of the digital economy are actively colliding.
Okay, according to deep dive reporting from TradingKey and SiliconANGLE, Stripe, which is the private payment processing behemoth currently valued internally at around $159 billion, they have partnered with Advent International, a massive private equity firm.
And Advent recently closed a $26 billion buyout fund, giving them immense dry powder.
Right, they have cash to burn. Together, they've launched an unsolicited all-cash bid to acquire PayPal and take it private.
The audacity of this bid is just historic.
Unbelievable.
We are talking about a private tech company and a PE firm attempting to swallow one of the original publicly traded giants of the internet era. The offer on the table is $60.50 per share in cash.
To understand the magnitude of that offer, you have to look at where PayPal was actually trading before the leak. It closed the previous day at $47.37. So Stripe and Advent are throwing a 28% premium directly at the board.
That's a massive premium.
It values the entire transaction at a staggering $53 billion. And they aren't looking for, like, seller financing or complex stock swaps. The reports indicate they have $50 billion in hard, committed bank financing lined up and ready to deploy.
And the market reaction to this kind of capital deployment is always violent. Upon the news breaking on July 15th, PayPal stock, trading under the ticker PYPL, just exploded upward by nearly 21%, hitting $57.16.
The technical analysts at TradingKey broke down exactly what that surge looks like on the charts. It's fascinating. They noted that the stock gapped up massively, blowing right past a historical resistance level of $52.22.
It just blew right through it.
Yeah. The buying pressure was so intense that the RSI, the Relative Strength Index, which measures momentum, spiked to 89.
And an RSI of 89 is an extreme outlier. It indicates a severely overbought condition, meaning the algorithmic trading and retail frenzy drove the price up so rapidly that a near-term cooling off is almost mathematically guaranteed as traders lock in quick arbitrage profits.
But the key takeaway from the technicals is how the market is actually pricing the probability of the deal happening. That gap up to $52.22 is now the new support level.
Right.
As long as KYPL holds above 52, the market is signaling it believes a deal will happen. The next resistance levels above are $59.66 and $61.66. And it is no coincidence that the $60.50 offer price sits perfectly in the pocket between those two technical ceilings.
But you know, the financial engineering and the technical charts are secondary to the massive strategic question here. Why?
Yeah, why do this?
Why does Stripe, a company fundamentally built on developer-friendly API infrastructure, want to spend $53 billion to buy a legacy consumer-facing brand like PayPal?
Well, let me build on an analogy to explain the architecture here. Think of global e-commerce as a massive digital shopping mall. For the last decade, Stripe has been obsessed with building the ultimate infrastructure for the store owners, the merchants.
They want to run the back end.
Exactly. If you want to launch an app or a storefront and seamlessly process credit cards in 100 different currencies without worrying about fraud or banking regulations, you integrate Stripe's API. They are the concrete, the wiring, and the plumbing of the internet economy.
They completely dominate the back-end developer experience. But they have historically lacked the direct relationship with the end consumer walking through that mall.
And that is exactly what PayPal owns. PayPal owns the shoppers. They have over 400 million active consumer accounts globally. They own Venmo.
People trust Venmo.
Right. People have PayPal and Venmo installed natively on their home screens. Consumers don't have a Stripe app. Stripe processes the payment, but PayPal owns the behavioral data, the loyalty, and the direct interface.
So the strategic logic of the merger is to create an inescapable closed-loop financial ecosystem. If you combine Stripe's absolute dominance in merchant acquiring with PayPal's massive consumer wallet penetration, you essentially control both sides of every transaction.
But I want to push back on that because integrating these two behemoths seems like a technological and regulatory nightmare.
Oh, regulators are going to have a field day.
For sure. The sources specifically state that Stripe and Advent want a 50-50 split in ownership, and crucially, they do not want to break PayPal up. They want to integrate it whole. But Stripe's payment gateway directly competes with Braintree, which PayPal actually owns.
Right.
And Stripe just launched a checkout tool called Link that competes directly with the PayPal-branded checkout button.
Aren't they just buying massive redundancies that regulators will flag immediately?
The antitrust scrutiny will be historic, no doubt.
Yeah.
The FTC and the DOJ will absolutely interrogate the overlap between Stripe and Braintree. However, the acquirers clearly believe the synergies outweigh the regulatory friction.
What's the real play then? Well, the primary synergy they are targeting might not actually be traditional credit card processing at all. The real prize here is the architecture of the next decade. Crypto and stablecoins.
Okay, this is where the narrative shifts from traditional fintech to the frontier of digital sovereignty. Stripe has been executing a very quiet, highly aggressive roll-up of crypto infrastructure.
Yes. The SiliconANGLE reporting details this masterfully. In 2024, Stripe spent $1.1 billion to acquire a stablecoin infrastructure startup called Bridge Ventures.
$1 billion.
Yeah, and then in 2025, they bought a crypto wallet provider called Privy. They are actively assembling the pieces to build a parallel financial network.
Yeah, what is the one piece of the puzzle Stripe desperately needs but doesn't have the consumer trust to launch on its own? A globally recognized, branded stablecoin.
And PayPal has PYUSD?
Exactly. PYUSD is PayPal's proprietary stablecoin, pegged directly to the US dollar. The proposed terms of the acquisition suggest that PayPal's PYUSD and its broader crypto trading services would be directly integrated into Stripe's new stablecoin payment routing systems, like Tempo and Bridge.
We really need to explain why this matters. A stablecoin isn't just a speculative crypto token. It is programmable, borderless digital cash.
It's the future of money.
If Stripe and PayPal merge, they aren't just processing Visa and MasterCard transactions anymore. They become the primary issuer and router of a private digital dollar that moves globally, instantaneously, with near-zero transaction fees, completely bypassing the traditional correspondent banking system.
They are attempting to build a private, global, digital central bank. And the urgency to execute this $53 billion buyout now is driven by intense external competitive pressure.
From who?
While the analysts at Mizuho Securities pointed the finger directly at Elon Musk. They flagged the looming rollout of X Money. Musk is actively attempting to transform the X platform into the ultimate financial everything app, moving directly into Venmo's territory by offering high deposit yields and peer-to-peer transfers integrated with social media.
Right. The threat of a heavily capitalized competitor like X Money capturing the next generation of digital wallet users forces Stripe and Advent to act preemptively. The $53 billion bid is a defensive strike as much as it is an offensive consolidation.
So if the strategic logic is this sound, and there is $50 billion in hard cash sitting on the table representing a massive 28% premium, why hasn't the PayPal board of directors just signed the term sheet and taken the victory lap?
Because in corporate finance, valuation is deeply psychological, and timing is everything.
The trading key context is brutal here. Selling at $60.50 might look like a massive win for an investor who bought the bottom at $47. But corporate boards look at historical charts. Just last year, PayPal was trading comfortably around $78.
And go back to the pandemic tech boom, and it was soaring well over $100, peaking near $300 at one point.
Oh, man. The psychology of the boardroom is defined by the fear of capitulation. If the board of directors accepts $60.50 today, they are legally and permanently codifying the destruction of hundreds of billions of dollars in historical shareholder value.
They'd have to look their long-term investors in the eye and basically admit the hypergrowth era is over. We will never get back to $100. This PE buyout is the best exit we will ever engineer.
That is a bitter, career-defining pill to swallow for a legacy CEO and board, which is why they are stalling. They are playing a massive game of chicken centered entirely around one specific date, July 28th.
Ah, the Q2 earnings report.
Yes. PayPal CEO Enrique Lores had previously managed market expectations downward, issuing very conservative, low, single-digit growth guidance for this quarter. The board's entire strategy right now relies on sandbagging.
Oh, I see.
They are praying that on July 28th, Lores can step up and present an earnings report that completely obliterates those low expectations, proving that PayPal's internal turnaround strategy is actually finally working.
The leverage hinges entirely on that earnings call. If PayPal reports massive, unexpected growth in active accounts or transaction margins, the board can confidently reject the $60.50 offer.
Right. They can turn to Stripe and Advent and demand a renegotiation closer to $75 or $80, armed with hard data that the company is undervalued.
But the risk they're running is astronomical. What happens if the Q2 earnings are flat? What if they merely meet that low single-digit guidance?
Yeah, if the underlying business shows no signs of organic acceleration, the board loses every ounce of leverage they have. It basically becomes a breach of fiduciary duty to reject a $53 billion, 28% premium lifeline when your own core business is stagnating.
And if they let their pride get in the way, reject the deal, and Stripe walks away entirely.
The technical analysts are unanimous on that. The stock doesn't just drift lower. It violently crashes back through that $52 gap, likely returning to the mid-$40 where it languished before the Reuters leak.
We are watching a $53 billion poker game play out in real time, and the cards are getting flipped on July 28th.
It is the defining corporate battle of the year, and the outcome will dictate the architecture of digital commerce for the next decade.
It really will.
Well, this has been a massive journey today. Let's pull all of these threads together because the through line is incredible. We started this deep dive looking at the raw, physical flow of global energy.
The kinetic warfare in the Strait of Hormuz.
Right, where Hellfire missiles and drone strikes are being used to physically choke a maritime toll booth, driving the global cost of oil above $85 a barrel. We then traced how that physical supply shock forces domestic institutions, like the Bank of Canada, to use the blunt instrument of interest rates to build a fortress against inflation, holding at 2.25% and directly dictating the math on your home mortgage.
We observed the stark contrast of traditional finance, watching Morgan Stanley sit comfortably above the supply chain friction, rewarding its shareholders with a steady, increasing dividend powered by the massive moat of wealth management.
And finally, we watch the brutal consolidation of the future economy as Stripe and Advent attempt a historic $53 billion coup to seize PayPal, aiming to build a dominant, closed-loop global infrastructure for digital stablecoins.
Yeah.
We have tracked the flow of capital from physical oil pipelines to digital wallets.
Which leaves us looking at a fascinating, historically unprecedented split screen. On one side of the screen, you have traditional nation-states fighting brutal, kinetic wars over physical territory, geographic choke points, and raw commodities.
The old world.
Right. And on the other side of the screen, you have tech megacorporations spending tens of billions of dollars to consolidate control over a borderless, programmable digital currency infrastructure.
The new world.
Exactly. These digital stablecoins operate in a vacuum entirely outside the realm of physical choke points. A stablecoin transaction routing through a merged Stripe PayPal ecosystem does not care if the Strait of Hormuz is blocked by a naval blockade.
It is the ultimate collision between the physical legacy economy and the ascendant digital economy.
Exactly. And the profound question for you to mull over as you navigate this rapidly bifurcating world is this. When you look ahead at the next decade, which system will ultimately wield more direct daily influence over your privacy, your purchasing power, and your fundamental financial freedom?
Wow.
Will your life be dictated by the traditional monetary policies of your central bank and the kinetic border disputes of your government? Or will your economic reality be entirely governed by the impenetrable terms of service of a private tech giant that processes, routes, and potentially issues every single digital dollar you spend?
That is an incredible question to leave off on. Thank you so much for joining us on this deep dive. Keep challenging the headlines, keep following the money, and most importantly, stay insanely curious.